Hey guys, Eddie here from DilleenProperty, and today I'm going to talk about a controversial topic. This one right here has a lot of focus throughout a lot of people in the property investing industry, and what it is basically focusing on tax deductions, depreciation, and all that kind of stuff. I speak to a lot of people on a day-to-day basis, and a common thing that people come to me and say is that I want to reduce my tax, I want to get a lot of depreciation on a property, and that's the property investing strategy that I want to do. I want to save a lot of tax. And for me, from my experience with purchasing 13 properties by the age of 26, that is the wrong thing to be doing, in my opinion. Some people might not like that, but that's the wrong thing to focus on. If you're only going to focus on saving tax and negative gearing and focusing on depreciation, that's basically the wrong way to go. A few reasons why is that most of the time people say that. Most of the time, the only people that say that are the people selling you that stuff that's like either off the plan, really negative geared, doesn't have a high rental yield, and they're selling you on a motion that it's got brand, like saying you're buying a brand new house and land package, you're buying it for say $600,000 and it's going to rent out for $450 a week or something like that, something stupid. But they say, look, you can claim a lot of deductions, you can claim a lot of depreciation, and it will lower your tax. Bottom line, what happens if you lose your job but you don't pay any tax? You have no tax to get deductions back from. You have no money to claim back. So if you lose your job or you have no income, you're going to have to sell that property. That thing's going to be draining money out of your pockets. So for me, how I built my property portfolio and my thoughts behind it is, I purchase property that's going to help put money in my pocket, not take money out of my pocket to try to, not lose $1 to try to gain 30 cents back. That's a stupid idea in my opinion. That's negative gearing. I'm not a big fan of negative gearing. At the very, in my experience, at the very worst case scenario, you should be slightly negative, but you should try to aim for always neutral to positive gearing, and that's not cash flow. So if from my experience, I have a lot of people saying, oh, my property rent covers my mortgage, it's positive gear. That's incorrect. That would make it positive cash flow, but that's not positive gear, because you've got to take into consideration council rates, water rates, management fees, insurance, strata if it's a townhouse or a unit. You've got to take all that into consideration. So that's why for me, when I purchase properties, that if I purchase the properties that I've been purchasing for the the last 5-6 years, if they're worth say $250,000, they need to be rented out for $350 a week minimum. That's around a 7% rental yield. If you don't know what a rental yield is, you can. I've got a couple more videos that I'm sure I explain what it is, but it's just very basic, simple. So once again, I always aim for properties with really high rental yields to make sure that if anything goes wrong, you don't want to be the person that has to sell the property really quickly and then lose money on it, or has to lose your portfolio, because if you don't have an income, you're going to have to sell your properties because they don't look after each other. So most of all my properties, they provide an income and they look after themselves. There's only a few in the past where I purchased and they might be a little bit negative here and there. So $10-20 a week after your council rates, water rates, management fees, insurance, and all that kind of stuff, that's okay in my opinion. But if you're purchasing something as an investment property, say for example, people now that you live in Sydney and you only want to stick to Sydney because you think you're investing with emotion, that's not what I do. I take the emotion out of it. But for people that buy a property for $600,000 as an investment and think they'll think it's going to rent out for $450, $500, or $550 a week, that's still not good enough in my opinion. That's what gets you stuck. Reason being because if say you buy something for $600,000 in Sydney or Melbourne or something like that, that say you get $500 a week in rent, which makes it roughly 4% rental yield. Then you got to pay council rates, water rates, and all that other kind of stuff as well. So you might be minus $100 a week in cash flow after your mortgage comes out from your rent. So you might lose $100 there. Then council rates, water rates, management fees, and all that other kind of stuff, that might equal an extra $100 or $120. So you could be $200, $250 a week negative, which would be like $1,000 a month that you're losing because you're investing with emotion. So that's a whole nother topic. But just plain and simple. You know, those are the few reasons and my thoughts on it. So yeah, thanks for watching, and I'll catch you next video. See you guys. Bye.